Hello. In this set of slides, what we're going to do is talk about the relationship between risk and return. And we're going to use some examples of stocks and look specifically at that relationship for an individual stock as well as a portfolio of stocks. So we're going to be looking at several different risk measures, and in order to use the tools, we'll also have to do a little bit of review of statistics. So I'm going to start with the statistics. For those of you that have had stats already, this will be a review. For those of you that haven't, I will provide you with everything you need to be able to use the tools in the chapter. So first of all, we need to define what is a probability distribution. And there's really two types of probability distributions. There's a discrete probability distribution and a continuous one. We're going to be dealing with a discrete distribution because with the discrete distribution you have a finite number of possible outcomes. And with a continuous probability distribution there's an infinite number of possible outcomes. And so it's going to be much easier to deal with, if we're doing calculations off a distribution, it's going to be much easier for us to deal with a discrete with a finite number of outcomes. But I will show you how some of these tools apply to a continuous probability distribution. So here we have a discrete probability distribution with regard to the weather. And your discrete probability distribution should have all your possible outcomes listed along with the associated probabilities. So here we see that there either is going to be rain or no rain. And we have determined that there's a 40% chance of rain and a 60% chance of no rain. And notice that the probabilities can be represented by decimal, in which case they have to sum up to equal 1 because you have to have all your outcomes there, and so your probabilities have to sum up to equal 1. Or they can be expressed in terms of percentage, and if that's the case, they have to add up to be 100%. So either one is fine. So let's take a look at the probability distribution of Kelly Services. Kelly Services is a stock, and what we're going to do is we're going to assume only 3 possible outcomes for the returns on Kelly Services stock. And those outcomes are dependent on the economy and how well the economy is doing. If we have a booming economy, and it appears that we're guessing that there's a 30% chance of a booming economy, then Kelly Services is going to yield a 100% rate of return. If we have a normal economy and we see that there's a 40% chance of a normal economy occurring, then it is presumed that or forecasted that Kelly Services would yield a 15% rate of return. And if we have a recessionary economy and we see that the probability of a recessionary economy is 0.3, and again notice how this totals up to equal 1.0, Kelly Services is going to give us a rate of return of negative 70%, so we're going to lose 70%. So these are the projected rates of returns for Kelly Services under the different economic outlooks. Now, another stock is U.S. Telephone, and we're assuming the same 3 states of economy, a booming, a normal, and a recessionary, same probabilities as before. The only thing that's different is U.S. Telephone is projected to have different rates of returns for the different states of economy. So with the booming economy, U.S. Telephone is expected to yield a 20% return. With a normal economy, they project that U.S. Telephone will yield a 15% return. And with a recessionary economy, they project that it'll be a 10% return. So notice how the returns really don't vary much for U.S. Telephone, but for Kelly Services, there was a very large difference between the lowest return and the highest. The lowest was a negative 70, and the highest was 100%. Now what we want to do is calculate the expected rate of return for Kelly Services and for U.S. Telephone. And first of all, just to explain what the expected rate of return is, it is the weighted average return of the projected returns of the stock in each state of nature. Okay, so you can think of it as a weighted average rate of return for the stock overall, over all the different economic scenarios. The formula, I'll go through the formula first and then we'll go ahead and calculate the expected rates of returns for Kelly Services and U.S. Telephone. So the formula for the expected rate of return is right here, where the expected return is equal to the return that occurs in each state of economy times the probability that that state of economy will occur. And you multiply the rate by the probability and then sum them up and you get your overall expected rate of return. So let's go ahead and calculate one. Here is the calculation for Kelly Services. So here I've kind of taken that formula and I broke it out a little bit further to show you that, remember, we had three states of economy: a booming economy, a normal economy, and a recessionary economy. And then Kelly Services was going to give us a rate of return in each states of those economy. We projected a 100% here, a 15% here, and then a negative 70% here. So that's exactly what I've put down here in our expected return formula for Kelly Services. I had said, or we had seen, that there was a 30% chance of a booming economy and Kelly Services would give a 100% rate of return. Now notice I just converted everything to decimal, but you could put 100% in here. You should leave the probabilities in decimal form here outside the parentheses. But here you could have it in percentages, so I could have put 100%. Plus, now this is the normal state of economy, so we had a 40% chance of a normal economy with an expected rate of return of 15%, and then a 30% chance of a booming economy with an expected rate of return of negative 70%. And then when you go through the math on that, we see that the overall expected rate of return for Kelly Services is 15%. We do the same calculation for U.S. Telephone, and again there's the same states of economy, so we have the same probabilities. So 30% chance of a booming economy with, and if you remember, the return for U.S. Telephone was 20%, and then if we had a normal economy, we were projecting the return for U.S. Telephone to be 15%, and then if you had a recessionary economy, we were projecting U.S. Telephone to have a 10% rate of return. And so then when we do the math, we see that the expected rate of return just happens to be the same for U.S. Telephone as it does for Kelly Services. So given that the expected rate of return is the same for both of these securities, and I think it's pretty obvious which one of these securities is the riskiest, right? The expected rate of return doesn't tell us anything about the risk of a security, and let's talk about that a little bit more. So just to kind of summarize, the expected rate of return gives us only the average expected rate of return on the asset. It doesn't tell us anything at all about risk. So if we want to find out about risk, what do we have to, what statistical tool do we have to use? And in finance, risk is simply defined as variability. Okay, the more variability in returns that you have on a stock or any security, the riskier that stock is. So how do we measure variability? And the way we measure variability is through the variance or the standard deviation. And we generally prefer the standard deviation because it gives us an answer in units that we're familiar with. So here we go. Here's our two measures of dispersion, the variance or the standard deviation. And just like I said, we're going to take the square root of the variance to get to the standard deviation and use the standard deviation as our final answer. So exactly what are we calculating when we calculate the standard deviation? What does the standard deviation mean? What does it tell us? Well, it's easier to explain a standard deviation if we look at a continuous probability distribution rather than a discrete probability distribution. So if I were to create a continuous probability distribution for Kelly Services and US Telephone, they would probably look like this. Okay? Notice, remember, both of them had a 15% expected rate of return. So both of them are going to peak right at 15%. But Kelly Services, if you remember, had a large range of possible outcomes just in our 3-scenario probability distribution. So if we allow for an infinite number of scenarios, okay, look, here's our returns on our horizontal axis and the probability of those returns on the vertical axis. We know that those returns can go way out here and actually be negative, or they could go way out here and be highly positive. And like in our discrete probability distribution, it went to 100%. Here it could probably even go beyond 100%. So the returns of Kelly Services are very spread out. Okay, the opposite is true for US Telephone. With US Telephone, remember, the expected rate of return was also 15%, but in our discrete probability distribution, our return would only vary between 10% and 20%. And again, with a continuous, if we allow for every possible return for US Telephone and its associated probabilities, you get a curve that looks something like this, the green here, and you see it's much narrower than what you have with Kelly Services. And so what the standard deviation measures is how narrow or how wide that continuous probability distribution is. So the smaller the standard deviation, the less spread out is the continuous probability distribution. Okay, the larger the standard deviation, it means the more spread out the distribution of returns for the security. So just to put it another way, if you have a large standard deviation, there's a much higher probability that your returns are going to be way off from your expected rate of return. Whereas if you have a low standard deviation, a small standard deviation, it's much more likely that your actual return will be close to your overall expected rate of return. So, how do we find the standard deviation? Well, I broke it up into 4 steps here, and we'll go through a couple of calculations so that you can see exactly how it's done. Here is the formula. This is the overall formula for the standard deviation, but I took that formula and put it and just kind of wrote it out, and you can follow that if you prefer, or you can use the formula, either one. Again, the above is just a written version of the formula. Alright, so first step, you've got to calculate the expected rate of return, which we've already done for both Kelly Services and US Telephone. The second step is we want to subtract the expected rate of return from each one of those projected returns for the 3 states of economy for the stock, and I'll show you that in just a minute. And once we subtract the expected rate of return from that, we want to square that number. So we want to square those deviations and then multiply it by the corresponding probability of occurrence for that state of economy, sum it up, and then take the square root to get the variance. So that was a whole lot of words right there, but let's go through a couple of examples and you'll see step by step exactly what I'm talking about. So here we have Kelly Services. The expected rate of return, as we said, we already calculated, is 15%. So now I put steps 2 and 3 together in one table. So step 2 said what we want to do is take each of the projected returns for the stock. So for Kelly Services, remember with the booming economy we had a 100% possible rate of return. For normal it was 15, and for recession it was a negative 70. And so from that we want to subtract the expected rate of return to obtain our set of deviations. So I just subtracted to get my 85 here, 0 and negative 85. Okay, then the next step is we want to square these deviations. So 85 squared is 7225, 0, and then 7225 again. This just happens to be symmetrical because I have a perfectly normal distribution. It won't necessarily be symmetrical in all the problems that you work. It just happened to be so here, and it will be with U.S. Telephone as well. And so now I take my squared deviations and I multiply them by the corresponding probability for each state of economy. So we said there was a 30% chance of a booming economy, a 40% chance of a normal economy, and a 30% chance of a recessionary economy. So I'm just multiplying each of my squared deviations by those probabilities, and I arrive at these numbers over here. Now I can sum these numbers up and get the variance. And then I just have to take the square root of the variance to get the standard deviation. And I have a standard deviation of 65.84%. And that is very large, okay? And you'll see that once we compare it to U.S. Telephone. So what does that tell us? Well, a large number there again tells us that there is a lot of variability in the returns for Kelly Services. Okay, to put it another way, it tells us that our actual rate of return that we're going to get from Kelly Services is apt to vary a lot from that 15%. Now, we can apply the empirical rule and compute z-values and all of that, and your textbook, by the way, does that. But you can skip that portion or that segment of the chapter, because really, if we can capture what the standard deviation means here, we won't be using the empirical rule in this chapter. So again, you can skip the part that talks about z-values. Okay, so we have the standard deviation of 65.84%. Remember that. That's a big number. So let's compare that to U.S. Telephone. U.S. Telephone, we calculated the expected rate of return, and it is 15%, step 1. Step 2, these were the possible rates of returns for U.S. Telephone for the 3 states of economy, and from each one of those I am subtracting U.S. Telephone's expected rate of return to obtain my set of deviations. Okay. Now that I've got my set of deviations, I'm going to square these deviations. So 5 squared is 25. There's your 0 again, and negative 5 squared is 25. And now I'm going to take each of the squared deviations and multiply them by the probability of the proper state of economy or corresponding state of economy. So 30% chance of a booming, 40% normal, 30% recessionary. And I multiply and arrive at these numbers. Sum them up, that gives me the variance. I take the square root of the variance, and that gives me a standard deviation of 3.87%. So see how much smaller the standard deviation is for U.S. Telephone as opposed to the 65% standard deviation for Kelly Services. Huge difference. So this is telling us, this 3.87% basically is telling us that the standard deviation is very small, and so if you invest in U.S. Telephone, your actual rate of return that you're going to earn is not going to vary a whole lot from the expected rate of return. So in other words, it's a less risky stock. So the standard deviation, by the way, measures what we call the absolute risk of the security. So in absolute terms, we can say that Kelly Services is much riskier than U.S. Telephone because it has a much higher standard deviation. But we also want to look at a relative measure of risk, because sometimes we're willing to take on a higher level of absolute risk if we're better compensated for the risk that we're taking on. But again, with the standard deviation, you're measuring absolute risk, meaning absolute variability. So we can say unequivocally that Kelly Services has more variability than U.S. Telephone, and we know that by the size of the standard deviation. Now, here's the coefficient of variation. That's what I was talking about, in that even though the standard deviation might be larger for a security, for one security than another, we may prefer to invest in the higher standard deviation security because it better compensates us for that risk. So what the coefficient of variation does is it allows us to determine how many units of risk are we taking on for every $1 of return, or for every 1% return. In the examples we've been doing so far, we've been working with percentages rather than dollars, so we'll continue to work in percentages. So how many units of risk are we taking on for every percent return that we earn? So here I'm going to use two different stocks, stock A and stock B. Stock A has an expected rate of return of 26%, a standard deviation of 36%, and then to calculate the coefficient of variation, we just take the standard deviation and divide it by the expected rate of return, and we get 1.38. What that 1.38 tells us is that for every 1% return, we're taking on 1.38 units of risk. Okay, so it tells us how much risk we're taking on for every 1% return. Compare that to stock B, which has an expected rate of return of 20%, a standard deviation of 30%, and a coefficient of variation of 1.5 when you divide the standard deviation by the expected rate of return to get the coefficient of variation. Okay, so if I were to ask the question, which stock is riskier, stock A or stock B? That would be kind of a trick question, because it would depend on, are you talking about absolute risk or relative risk? Absolute risk is the absolute variation, okay? And without a doubt, since the standard deviation is larger for stock A than it is for stock B, stock A has more absolute risk. But if we want to look at the risk relative to the return, then clearly stock B has more risk than does stock A, because stock B, you have to take on 1.5 units of risk for every percent return, whereas with stock A, we take on 1.38 units of risk for every percent return. So you would have to clarify, which type of risk do you want, absolute or relative? And the coefficient of variation gives you the relative risk. In finance, we usually emphasize the relative risk. And there I summarized that on that slide where we've got stock A has the greatest absolute risk, stock B the greatest relevant risk. So to summarize the first part of this presentation, for individual securities, note we've been working with individual securities. We can measure the absolute risk by calculating the variance, or really we prefer to use the standard deviation. And for individual securities, we can measure relative risk by finding the coefficient of variation. Now we're going to work with portfolios. And a portfolio represents holding a number of different stocks. So in other words, instead of holding a single stock like we were in the earlier part of this presentation, now we're going to be looking at how do we find the standard deviation of a portfolio? How do we measure the risk of a portfolio? And a portfolio is holding more than one stock. You can have a 2-stock portfolio. You can have a 3-stock portfolio. You can have a 100-stock portfolio, but it just means that you're holding more than one. Now, mutual funds are the best way to get hold of a portfolio, and many mutual funds will have holdings in hundreds of stocks in their portfolio. most of our examples are going to be dealing with two stock portfolios just to keep the numbers reasonable and something that we can work with. But when we analyze risk from a portfolio sense, you'll find that it's quite different. So we're going to look at a couple more risk measures. Okay, let's say that there are two companies. One's Gold Mining Incorporated, the other one's Aluminum Incorporated. Okay, and you've got $100,000 to invest, and you're thinking about putting half your money in gold mining and half your money in aluminum. And if you do that, here is the portfolio rate of return, and I'll talk about how I got that in just a moment. So let's look at gold mining, the gold mining stock, for just a moment. If in recent years you had just invested in gold mining, then in 2016 you would have done really well. You would have earned a 40% return. In 2015 you would have lost 10%. In 2014 you would have gained 35% again, and then in 2013 you would have lost 5%. What would have happened if you put all your money in aluminum? Well, in 2016 you would have lost 20%, in 2015 gained 50%, 2014 lost 9%, and then 2013 gained 39%. So notice that the expected or average rate of return, which by the way I just got because I'm looking at the average rate of return over the 4-year period, so I just sum these up and divide it by 4. And that's how I got the expected rate of return for each one of these. So notice that whether you went with gold mining or aluminum, your expected rate of return is 15%, which of course would be the same if you had a portfolio of half and half. So the way I get the portfolio return is if I have half my money in gold mining, so it would be 0.5 times my 40% return, and then half my money lost 20%. Then when I do the weighted average calculation, I come up with a 10% portfolio return. So notice my portfolio return here doesn't vary as much as each of the individual stock returns. But let me go ahead and show you the formula for making that calculation. So the expected return on a portfolio is equal to the weight, and the weight's determined by the percentage of money that you've invested in that stock for the portfolio. So we said it was 50-50 for gold and for aluminum. So it'd be the weight or the proportion of money that you have invested in stock A times the return of stock A plus the weight of stock B, in other words, the proportion of money invested in stock B times the return of stock B, plus, and so on, for however many stocks you have in your portfolio. You'd want the weights for each one multiplied by the return. And notice that your weights have to sum up to equal 1. Can't be higher, can't be lower, has to be 1, because 100% of your money will be invested in this portfolio, and the whole portfolio makes up a 100% investment, and you have to break down the proportion for each stock. And then it's just multiplying to get a weighted average. So again, to show you how I got the number for the 2016 portfolio returns, remember we said 50% of our money is going into gold, and in 2016 it had a 40% return, and 50% of our money is going into aluminum, which we said had a negative 20% return in 2016. And so when you do the math, we end up with 0.10, or a 10% portfolio return. Now, if we didn't invest the money 50-50, we could have weighted it differently, right? We could have said, you know what, I have more faith in aluminum than I do gold, so I'm going to put $40,000 in gold and $60,000 in aluminum. And if that had been the case, what would my portfolio return be in 2016? Well, the only thing that would change are your weights. 40% would have been in gold with a return of 40%, and 60% would have been invested in aluminum with a return of negative 20%. So again, when you do the math, we end up with a portfolio return equal to 4%. So we know how to get the expected rate of return of the portfolio. Now we've got to measure the variability again. And we're going to do that again with the standard deviation, but something changes a little bit. There's something else we have to consider now when we look at measures of dispersion. Because what happens is, we just saw two very risky stocks, right? That, gold had negative and positive returns, back and forth, back and forth. Aluminum was the same way, but notice the portfolio returns were positive every year. So there's a correlation between those assets that we have to consider. So again, here you go. We're looking at the same example, and I went ahead and calculated the standard deviation for gold mining. And the standard deviation for gold mining was 26%. And like I mentioned before, obviously you can tell the standard deviation is going to be large because the returns are all over the place. Same way with aluminum. The standard deviation is large, it's 35%, because again, the returns are crazy. They're kind of all over the place. And the expected rate of return, of course, that doesn't change. It's still 15%. But notice that when I put these two very risky stocks into a portfolio, so I'm taking gold mining, which is very risky, big standard deviation, and aluminum, which is also very risky, big standard deviation. So I'm taking two very risky stocks, and when I combine them and put them in a portfolio, my risk nearly goes away. Okay, so how does that happen? So my question is, what condition is necessary to allow us to combine two very risky stocks and make up a portfolio that contains very little risk? And hopefully you can think through this, and you will notice that these two stocks are what we call negatively correlated. In other words, they tend to move opposite one another. So when we're dealing with a portfolio, we have to pay attention to the correlation of returns between the stocks or between the assets. So notice here that with gold mining does really well in 2016. Aluminum loses money. Gold mining does terrible in 2015. Aluminum does great. Okay, so always the opposite. They're moving in opposite directions. So because of that, we know that they are negatively correlated. Okay, now we don't know yet the degree of the negative correlation, and I'll talk about that in just a minute. But clearly these stocks are negatively correlated. And also, just to add in another point, forget these negative signs occur. Keep the numbers, keep all the numbers here, but just pretend that the negative signs weren't there. The stocks still are negatively correlated in their returns, because if gold mine is yielding 40%, aluminum, let's say, is yielding 20%, notice gold mine still drops from 40% to an assumed positive 10%. Aluminum goes up. So while gold mining is going down, even though it's still positive, if we pretend the negatives aren't there, notice here it goes up. And here it goes down from 50 to 9%, again assuming the negative's not there. And here it goes up from 10% to 35%. So that you don't have to have negative numbers there, is my point, in order to have negative correlation. It's just that if the returns move opposite one another, then you have negative correlation. And that's the condition that has to be necessary to allow us to diversify away that risk. Now, to talk a little bit about correlation coefficients. Correlation coefficient can range between a -1 and a +1. If you have two stocks that are perfectly positively correlated, then it has a correlation coefficient of 1. Okay? And what that tells us is that those two stocks move together all the time. Okay? Very strong relationship between the movement of those two stocks. Okay? In fact, it's perfectly strong. They move together all the time. Alright, and then let's take the other extreme. Perfect negative correlation means that they move opposite each other all the time. Okay, but the truth of the matter is usually the assets are going to be somewhere in between. They're not going to be a perfect positive one or a perfect negative one. And so you can have correlations that run anywhere in between. It's just they can't go outside the bounds of positive or negative 1. So if we have a correlation coefficient 0.5 or greater, we still consider that a strong positive correlation, but it's not perfect. So let's say that you had a correlation of 0.8. Okay, what that means is that those two stocks move together most of the time, but not always all the time together, not perfectly together, but most of the time they're pretty strong correlation. You could have a negative correlation, let's say, of negative 0.6, which means they tend to move tend to move opposite one another, not together. They tend to move opposite one another, but it's not a perfect opposite movement. Okay, so this tells you, however, how close we are to the extreme tells you how strong the relationship is between the two securities. Zero correlation, by the way, can occur, and that simply means that there's no relationship at all between the two assets. So when one asset goes up, the other asset may go up or down. You don't know. There's just no correlation between the two. So now let's go ahead and try measuring the portfolio standard deviation. And we have two stocks, stock A and B, and here's the information given on those two stocks. We've got an expected rate of return for stock A of 14% and 17% for stock B. Both stocks A and B each have a standard deviation of 11%. So in terms of variability, absolute variability, they are identical. They're both 11%. We have 35% of our money invested in stock A and 65% of our money invested in stock B. So this is going to serve as our weights. And then down here, we're going to say, all right, let's calculate the portfolio standard deviation assuming 4 different correlations. So first of all, we're going to do 4 calculations. We're going to do it assuming the correlation coefficient is positive 1, meaning perfect positive. They move exactly together perfectly. And then assuming that the correlation coefficient is a positive 0.4, meaning they tend to move together, but it's kind of a weak relationship, so not but by the same amounts and not all the time. 0, meaning that they don't move together there's no relationship. One might be up or down when the other one's up or down. You just don't know. It could go either way, or it does go either way. It goes both ways. And then a negative correlation of 0.6, which it means that they move opposite one another, but it's not perfect, but it's fairly strong. Okay, so they do that most of the time. So we'll calculate this 4 times. So first of all, let me go ahead and present the formula and explain the formula. Okay, this is the standard deviation of a portfolio formula if you have a 2-stock portfolio. And it expands very rapidly if you have 3 stocks and then 4 stocks and so on. So we won't be dealing with anything more than a 2-stock portfolio. But notice, let's go through the terms because it's important to see what is impacting the variability of the portfolio. So first of all, we see that we want the weight of stock A, and we're going to square that. The weight of stock A is the proportion of money we have, the proportion of our money we have invested in stock A. So we're going to take that proportion and square it. Then we take the standard deviation and square it, which by the way is the same thing as the variance, plus the proportion of money you have invested in stock B, and square that, times the variance of B, or the standard deviation of B squared, plus 2 times the proportion of money we have invested in stock A, times the proportion of money we have invested in stock B, times the correlation coefficient of stocks A and B, and notice that's represented in this case by Greek letter rho. You will also see it represented by the Arabic letter small r. So either r or rho represents the correlation coefficient. And by the way, the correlation coefficient has to be given to you. You won't be asked to calculate that. So that's a number that will always be given to you in the problem. And then you multiply that by the standard deviation of stock A times the standard deviation of stock B. And once you go through all this math here, don't forget to take the square root. And then you have your standard deviation for the portfolio. So let's do the first one and find the standard deviation for the portfolio, assuming that the correlation coefficient is 1. So the standard deviation for the portfolio is equal to, we said in the previous slide, our proportion of money invested in stock A was 35%. So here's our weight in stock A, 35% squared, times our standard deviation of stock A squared, plus the proportion invested in stock B squared, times the standard deviation of stock B squared, plus 2 times the proportion invested in stock A times the proportion invested in stock B times the correlation coefficient of stocks A and B, which we're giving to be 1, times the standard deviation of stock A and the standard deviation of stock B. And sure enough, we get a standard deviation for the portfolio equal to 11%. And the thing is, we can actually know that before we even do the calculation, and here's why. These two stocks both have a standard deviation of 11%, and they're perfectly positively correlated, meaning they move together perfectly. So therefore, if you're going to take these two stocks with the same variability, and they move exactly the same all the time, I mean they're basically the same security, then when you combine them, sure enough, you're going to have the same variability. You're going to have 11% again. Okay, so that should make intuitive sense. But just to kind of break this down, notice to get the standard deviation for the portfolio, we're considering, how much money we have invested in the one asset, and then the variability of that one asset, the proportion of money invested in the other asset, in this case stock B, and the variability of that. And then this last term is taking into consideration how they move against one another. And in this case, they move exactly together, which is why we don't have any risk reduction. In other words, the standard deviation of the portfolio is the same as the standard deviation of the two individual stocks. There's no risk reduction here because they move exactly together. Now, let's do the calculation again, but this time we're going to say that they're positively correlated, but it's not perfect. It's a weak relationship. And we're just going to make it a 0.4 and see what happens. So the only number that changes, all these are all the same, the only number that changes is this number here, the correlation coefficient, because we're using the same example. So the correlation coefficient is 0.4, And now when you do the math, you get 9.38%. So notice that when we combine two stocks that have a standard deviation, in this case of 11% each, when we combine them, the standard deviation actually goes down to 9.38%. And the reason it goes down a little bit is because the stocks don't move together perfectly. Okay, they are still positively correlated, but they're not perfectly positively correlated. So point being, as you move farther down that continuum away from perfect positive correlation, you will get some risk reduction. So you can even have some risk reduction with a positive correlation as long as it's not perfect. All right, let's see what happens with the other two correlation coefficients that we wanted to look at. So what if the correlation coefficient is 0? So again, that's the only number that changes in our example. Here we have a correlation coefficient of 0. So when we do the math, we end up with a standard deviation for the portfolio of 8.12%. So notice we've come down a little bit more. Okay, we've got two stocks that individually have an 11% standard deviation, but when you combine them and they have no correlation to one another, the standard deviation for the portfolio is 8.12%. And then you'll see even more risk reduction here when we change the correlation coefficient to a negative 0.6, meaning they tend to move opposite one another in a fairly strong relationship in terms of doing that. Look what happens to the standard deviation to the portfolio. It goes down even more, down to 5.74%. And then you could do this exercise on your own if you wanted to look at the correlation coefficient for stocks A and B, assuming they had perfect negative correlation, you would get 3.3%. So you don't diversify away all the risk, but you're able to get some of that risk, or actually most of that risk away. You're just left with a little bit. Okay, so to summarize, the portfolio standard deviation measures the total variability or the total risk of the portfolio, and the risk can be reduced by investing in securities that have any correlation less than perfect positive. And the farther you move away from perfect positive correlation, the more risk reduction you get. Now, as we said, the standard deviation for the portfolio is what we call total risk. But we can divide total risk into two parts: non-diversifiable risk or market risk, or what's sometimes called systematic risk, versus diversifiable risk or company-specific risk or non-systematic risk. Okay, and you should be familiar with all these terms because they do kind of get used interchangeably in the book and on the exams. So it would be good to know all those terms. So we can break risk up into these two components. So first of all, what do we mean by each of these components? Diversifiable risk is just like it implies. It implies that it is a risk that can be diversified away. So if we can take total risk and divide it into two parts and completely get rid of this risk, this is the only risk we have to worry about. And actually, this is the only risk that the market compensates us for, because the market assumes that we're holding a diversified portfolio. How is it that we're able to get rid of this risk? What exactly is this risk? This is company-specific risk. So, for instance, when a company gets hit with a lawsuit, so let's say General Motors gets hit with a lawsuit because of some sort of product failure in a car, and it caused a car accident, possibly a bad injury or a death. And then that forces a recall of a bunch of cars. I can guarantee you General Motors will experience a pretty significant drop in their stock price. Okay, that's a company-specific risk. It just happened to GM. It didn't impact any other companies. And let's say that GM's in your portfolio, so that part of your portfolio gets hit with something negative. On the other hand, let's say that you are holding Amazon as well, and Amazon announces earnings higher than expected. And so soon as, that's great news, and as soon as that news hits the market, Amazon stock increases significantly. So the point being is that if you hold a bunch of different stocks, you're going to have all this, sometimes it's referred to as noise. You're going to have all this noise. In other words, some companies are going to have good things that happen to them and cause their stock price to tick up for a while. Some companies are going to have bad things that happen to them and cause their stock price to tick down. And the more stocks you hold in your portfolio and the more diversified those stocks are, in other words, across different industries, if they're all in one industry, then you're not holding a diversified portfolio. They have to be across different industries and so on and so forth. Then some stocks are going to go up, some are going to go down because of things that happen within the company, and they just cancel each other out. So you are diversifying away this risk. What you cannot get away from is the market risk, because market risk or systematic risk or non-diversifiable risk is risk that hits every single stock on the market. Okay, it doesn't matter which stock you're holding, you're going to get hit with anything that causes a change in the market risk. So usually it's some macroeconomic event that will cause a hit to the market. So for example, unexpected increase in inflation, change in interest rates, any sort of major political event that wasn't expected, a war. Those are all things that if you're holding 100 stocks, that is going to impact every stock in your portfolio, and you just can't get away from that. So this is the risk that we have to worry about. This is the risk that we have to try to manage. Okay, is this market risk or the systematic risk? Now, one thing that's important to note, though, is that even though all stocks are going to be sensitive to these these macroeconomic events that happen, some stocks are more sensitive to them than others. And we can measure that sensitivity with what we refer to as the beta of the stock. So beta is going to measure, I'm going to go to beta in the next slide, but I want to point out here, beta will measure how sensitive the stock is to market risk or systematic risk. Okay, so here's beta. By definition, beta is the tendency of a stock to move with the market. Okay, it is an index, so it is indexed to the market. The market as a whole is said to have a beta of 1, and that's considered to be average risk. And so a stock that has a beta equal to 1, you would say that stock then tends to move with the market. All right, 6 things about beta you always wanted to know but you were afraid to ask. First of all, how do you calculate betas? Well, let me just say you don't have to calculate them. You'll be given them. You'll be given the betas needed to do your calculations. But someone has to calculate them somewhere. And point 2 being the easiest way to obtain the beta is to go to Yahoo Finance, and you can pull up any stock and see what the beta of that stock is. But the way that beta was calculated was that someone ran a regression of the returns of a particular firm's stock against the returns in the market. So for example, if you wanted to look up the beta for Caterpillar, and let's say the beta for Caterpillar, I'm not sure what it is right now, but it has been right around 1.7 or so. So if the beta for Caterpillar, if you look it up on Yahoo Finance and you see it's 1.7, the way they got that is they took the stock returns of Caterpillar over a particular period and regressed that against the returns on the market. And the slope of that regression line is the beta of Caterpillar stock. And that beta represents how volatile Caterpillar stock is compared to the market. That's what the beta measures. So as I mentioned before, the beta for the market as a whole is equal to 1. The beta for an average risk stock is considered 1. So if you have a stock that has a beta of 1, we're like, oh, that's average risk because it's equal to the market. If you have a stock that has a beta of greater than 1, then that's considered to be an above average risk stock. And if it's less than 1, it's considered to be a below average risk stock. So you can have betas of 0.5, you can have betas of 1.5, and more than that and less than that. So what do you do with beta? Well, beta is going to allow us to specify a relationship between risk and return by employing it in the capital asset pricing model. We call it CAPM for short. So I'm going to give you the capital asset pricing model here in just a minute. And what beta does is beta is going to be our measure of risk, because the higher the beta, we know the more volatile it is compared to the market. And so that's our risk measure. And again, it's measuring the sensitivity of the stock to general market risk, to those macroeconomic events that impact the entire market. So we need something that's going to capture that risk and then tell us what our return should be. So that's what CAPM does for us. Capital asset pricing model isn't perfect. There's been all sorts of tests run on the capital asset pricing model to see how perfect it is, but it is used in practice. It's not perfect, but right now there isn't another model that really does a better job than CAPM. And what CAPM will do is it will tell you as an investor what rate of return you should require given the risk of the asset and given the general level of interest rates and risk premiums going on at the time. So you'll see all that with this next slide. So here's the equation for CAPM. So let's just say that we have stock J. So the question might be, what rate of return should you require in order to invest in stock J? Assuming a certain risk-free rate of interest, and that has to be given to you, plus the beta of stock J. So in other words, we want to take the risk of stock J into consideration. But then we have to know, on average right now, what is the market paying? What's the return on the market? Okay, so again, that would have to be given to you. And in theory, this is supposed to be every single asset that exists in the marketplace, but we don't have a measure of every single asset that exists in the marketplace. What's the return on that? So we use a proxy or a substitute, and that's usually the Standard & Poor's 500 index, or if you're looking at smaller companies, it might be the Russell. So what, that varies. You just use whatever they give you, in the problem, minus the risk-free rate. Okay, so, and again, I've got everything defined here. So notice that with CAPM, the higher your risk, the higher is going to be your required rate of return. So let's go ahead and go through a numerical example. So what's the required rate of return of the stock of company Z with a beta of 1.5? And we'll assume that the risk-free rate is 7%. And the return on the market portfolio of assets is 11%. Okay, first of all, in practice, the way we find the risk-free rate, that's a really high one right now, 7%, But the way we would find the risk-free rate is we would observe and see what the Treasury bond rate is right now, and because Treasury bonds are considered to be a risk-free security. So that's generally what's used as the substitute for the risk-free rate in the capital asset pricing model. Now there are some that argue that the Treasury bill rate, the short-term Treasury security bill rate, is a more pure measure of a risk-free rate of return. But generally I prefer using the T-bond rate because the holding period is more consistent with the holding period of a stock. In other words, generally stocks are held for a longer period of time, and the Treasury bond has longer term inflationary expectations embedded in it than does the Treasury bill rate. But I guess point being, whatever's given to you in the problem, if they tell you the Treasury bill rate is 7% or the Treasury bond rate is 7%, then that's what they mean for you to use as the risk-free rate for that security, or for that equation, not for that security, but for that equation. And then the return on the market portfolio, like I said, we don't have anything that measures the return of every single thing on the market, so we have to use a proxy again. And so usually it's a Standard & Poor's 500, but at any rate, it'll be given to you in the problem. And so then we just plug it into the CAPM equation. So what rate of return are we going to require to invest in company Z? Well, CAPM says to take the risk-free rate, which is 7%, plus the beta, or the risk of the stock, which is 1.5, and multiply it by the return on the market minus the risk-free rate, which this term is referred to as the market risk premium, and I'll come back to that in just a minute. So if you just do the math here, we get 7% plus 6%, which comes up to a total of 13%. So what this is saying is that in order to invest in this security, a fair rate of return would be 13%. Okay, 13% should be the rate of return that you're requiring. So that's pretty straightforward. But there's a couple things in this equation I do want to point out. As I mentioned, this is referred to as the market risk premium. Notice if you take 11% minus 7%, we get 4%, correct? So what this is telling us is that the market is paying a 4% premium over the risk-free rate to take on average risk, right? Because the market has a beta of 1, it is average risk, and if the market is paying 11%, it's paying 4% over the risk-free rate, so therefore the market risk premium is 4%. Okay? And I mention this because sometimes in a problem, rather than giving you the market portfolio return of 11%, instead I could have said, and the market risk premium is 4%. So if it were stated that way, this subtraction has already been done for you, and you would have plugged in 7% plus 1.5 times 4% and then gotten the same answer. Okay? Notice if the market is paying a 4% risk premium, what's the security's risk premium? What's security Z's risk premium? Well, it's 1.5 times the market, because it's 1.5 times, or because it's 50% riskier. So it's going to pay a 50% higher risk premium. So instead of 4% risk premium, the risk premium for the assets is whole second term, which is 6%. Okay, so just kind of breaking down this equation a little bit. So that's the CAPM if we have a beta of 1.5. Let's calculate another one. Now let's assume we have a beta of 0.5. What would be the investor's required rate of return? So plugging the numbers again into CAPM, we have a risk-free rate of 7% plus the beta of 0.5 times the return on the market minus the risk-free rate gives us, notice this asset has a risk premium of only 2% because it's got a very low risk. It's half as risky as the market. So therefore, this asset's beta, this happens to be another stock Z, is 9%. This is what if stock Z's beta was 0.5 instead of 1.5. Your required rate of return would be only 9%. So notice beta is going to determine, the higher the beta, the higher the required rate of return. Okay, so the risk-return relationship is a direct relationship. The higher the risk, the higher the required rate of return should be. Now we can graphically specify the capital asset pricing model. So if I take the results that I just got with my last couple problems and take the information from that problem, I can draw a graph that will tell you or show you what the investor's required rate of return is. Okay, that's on here on the vertical axis. So here's your required rates of return for every single beta. And so you can just kind of see what the risk return trade-off is at a given point in time. Alright, so remember in our earlier example, or actually just in our last slide, when we had a beta of 0.5, that told us that we should require a 9% rate of return, which is exactly what's plotted here. And then in the slide before that, we were told if we had a beta of 1.5, right, which would be right here, then our return should be 13%, which if you move across, you'll see we're right at 13%. Okay, so those are 2 points we can plot. We know the market has a beta of 1, and the market's paying 11%. So if you move that across, you'll see it's right in between 10 and 12 there, so it's at 11%. So that's our third point. And then our fourth point is, what if we have a beta of 0? What's our return? Well, a beta of 0 would mean no risk, or risk-free security, such as a treasury bond. And we said the risk-free rate was 7%. So that's plotted here. And so when you connect the dots, you get what's called the security market line. And again, the security market line is simply a graphical depiction of the capital asset pricing model. Now there are a couple of things that can change the security market line, and so we'll talk about that. So the first thing we need to do is look at interest rates and break interest rates down into different parts. So when you see a stated nominal interest rate, what that's equal to is the real rate of interest plus some inflationary expectation that's embedded in that number. Okay, so there's some forecasted inflationary expectation, but sometimes we're wrong on that. Okay, sometimes inflation may be higher than expected and sometimes even lower than expected. So what happens if inflation ended up being higher than we expected? Because only the expected inflation is reflected in that nominal interest rate. Okay, what'll happen is it'll cause the required rates of returns for all securities to go up by the amount that inflation increased beyond expectations, which means that it'll cause the security market line to shift upward. So to show you what I mean, here's my original security market line where my risk-free rate was 7%. Here's my beta 0.5 at 9%, my market at 11%, and then my beta of 1.5 at 13%. If inflation increased 2% more than we expected it to be, okay, so more than what's already embedded in these rates of returns, then it will cause a 2% shift upward in the security market line, simply meaning that every single security will increase its rate of return by 2%. So now our risk-free rate is 9% instead of 7. Our 0.5 is 11% instead of 9, and so on. Okay, so we have a complete shift in the security market line. And I want to point out that the risk-free rate shifted as well because of that unexpected change in inflation. The reason I want to point that out is because there's a second thing that changes the security market line, but you'll notice the risk-free rate doesn't change. So the second thing, here we go, the second thing that changes the security market line is when we have a change in investors' risk aversion. And a change in investors' risk aversion could mean, like if there's an increase in investors' risk aversion, it means that they are more averse to risk right now. And so in order to entice them to invest, you're going to have to offer them a much higher risk premium. The riskier the asset, the larger that risk premium has to be in order to entice people to invest. Investors' risk aversion will increase maybe because the economy's not doing well, people are losing their jobs, a lot of layoffs going on. And so when we have that state of economy occurring, investors start worrying about holding on to riskier assets, and they start investing in risk-free assets instead. So they kind of push all their money into, not all their, but a good portion of their money into risk-free assets. And so now what companies have to do that have, betas that reflect risk, before where you might have been happy taking on a stock that had a beta of 0.5, you were happy before with a 9% return. Now you're going to require an 11% return to invest in that company because you've become more risk averse. Before, when the market was paying 11% for average risk, now it looks like it's paying roughly about 14% for average risk. In other words, notice how that risk premium keeps getting wider and wider, bigger and bigger as the risk increases because people are risk averse, and you're going to have to compensate them increasingly more as you're increasing your risk. Okay. Also notice this isn't a shift in the security market line, it's a rotation. Okay, so it rotates up because of the increase in risk aversion. So the slope of the security market line is higher. The risk-free rate doesn't change because risk-free means there's no risk here, so investors aren't requiring a higher rate of return for no risk. In fact, that's where they're putting all their money. They're requiring a higher rate of return because of risk, because they're afraid of risk. So that's why it's a rotation rather than a shift that we saw in the previous slide. Here, what we're going to do is we'll end this presentation pulling two important models together to find an equilibrium stock price. So we're going to use CAPM, the capital asset pricing model, and the constant growth model to find the equilibrium stock price. So suppose you want to invest in a stock that currently costs $42, and you know that the firm plans to pay a $2 dividend next year, and dividends have been growing at a constant rate of 8%, and that is expected to continue, so we have a constant growth rate of 8%. We also know that the risk-free rate is equal right now to 4%, the return on the market is 10%, and the stock's beta is 1.5. If the stock is priced fairly, or is the stock priced fairly? That's the question. Is the stock priced fairly? Is it undervalued or is it overvalued? So what we can do is use the CAPM equation and the constant growth model, sometimes called the Gordon model because it was named after Myron Gordon. We can use those two models together to determine what the equilibrium stock price should be for that security. So taking the information and plugging into CAPM, we've got the required rate of return for the security is equal to the risk-free rate. So all this information was just given on the previous slide. The risk-free rate plus the beta for the stock multiplied by the return on the market minus the risk-free rate. And that tells us that investors' required rate of return to invest in this stock should equal 13%. So it should be 13%. So using the constant growth model, or the Gordon model, this required rate of return here that you calculated using CAPM is exactly the same required rate of return that we use here in the constant growth model. So we just take the 13% and plug it in down here, and then also you'll recall with the constant growth model we need next year's dividends, which was given to us in the problem to be $2, and we need the growth rate, which was given at 8%. And so when we plug those numbers in, we get a price of $40. So notice in the problem it said that the stock is currently priced at 42. And here we're showing the equilibrium price is actually $40. So we would say that the stock is currently overvalued. It's valued at $42 when it really should be valued at $40. And if you believe in efficient markets, what's going to happen is very, very quickly, it's going to happen so fast it's going to be hard, you can't profit from it, but very, very quickly the market's going to recognize that the stock's overvalued and there's going to be a bit of a sell-off, and then when that happens, that's going to bring the stock price down to $40, and it should end up at its intrinsic value at about $40 a share. Now I could have phrased the question and asked you, what if the market price of the stock is $39? Well, if the market price is $39, but we know it's really worth $40, then this is a bargain. And this means investors would run out and try to buy the stock. But again, because market forces are going to act so quickly, assuming efficient markets, that the price is very quickly going to rise to its intrinsic value of $40 a share as the stock is, as demand for the stock grows because it's undervalued. Okay. So that's a good way to kind of summarize how CAPM and the constant growth model can be used together to determine an equilibrium stock price. So that's our conversation about the relationship between risk and return.